Hey, what's going on? This is Jerry Fetta, CEO of Philanthro Wealth, coming to you with another weekly wealth walk. I want to talk to you about something called the three-tier capital system. So this is something banks actually use. So three tiers, you know what tiers are, like three groups of things, right? Capital meaning money, and it's a system. It's how they actually build their reserves, right? So the first tier of reserves for a bank or a financial institution is called their tier one reserves. These are their most safe priced reserves. It's like the money that they don't ever want to lose. That's really what it is. It comes down to they make profit. A certain allocation is going to be money that they don't ever want to lose. It's going to stay in reserves. And the point of it is for solvency, right? Like it's kind of like sleeping with the gun under your pillow financially. It's like having, an extra, fortified foundation if you live in an area where there's hurricanes. Hopefully you never have to use it, but it's there. Okay. So the number one place that banks actually put their tier one capital is life insurance. Okay. Believe it or not, it's called bank owned life insurance. If you go Google this, you can go see that collectively there's over 3,000 banks in the United States of America that have their tier one capital in life insurance in high early cash value dividend paying whole life insurance. So it's a very specific kind. It's not variable universal life insurance. It's not index universal life insurance. Okay. You can't put money in term insurance. It's definitely not that, right? It's specifically high early cash value dividends paying whole life insurance. So it's not even ordinary whole life insurance. So your boy at Northwestern Mutual that's been trying to sell you that policy, it's probably not what he's selling either. It's structured for high cash value. Okay. So Google bank owned life insurance, you're going to see over 3,000 banks, over $200 billion collectively, right? And these are not like the small, just community banks. Sure. Yeah, they do it, but so does Wells Fargo. Bank of America has over $20 billion in life insurance cash values. Okay, Wells Fargo, PIMCO, JP Morgan, right? These are some of the big players in the US, and that's where they keep their reserves. Okay, the biggest banks in the United States, they're the number one owners and purchasers of high early cash value dividend paying whole life insurance. I just call it the sacred account. Okay, I don't want to have to say high early cash value dividend paying whole life insurance every single time I say it. So I just call it the sacred account. Okay, so that's what that means. So if you're sitting there today and you're like, yeah, I'm trying to build reserves. Right? Building wealth. Like part of building wealth, you've got to have a layer of like reserves. What if something happens? Okay. I like to have 6 months of reserves minimum for my business and for my personal expenses, right? So I'm going to have that in my life insurance policy. I'm going to design it with high cash value, just like the banks do. And I'm actually going to be able to become my own banker. Okay. We have other strategy videos. If you look on my channel and you look at the sacred account, the infinite banking concept, becoming your own banker, all of that, the three-tier capital system flows into that. Okay, there's another thing called the banking quadrant. So check all of these things out. We can put resources below if you'd like, right? The other one is now tier two. Next, I don't want to interrupt you too long. I just want to give you a free offer for my book, The Blueprint to Financial Freedom. If you go to jerryfetta.com/B2F promo, you can get the book now. I'm going to let you get back to the video. So we talked about tier one, which is life insurance. Tier two is what's considered a revaluation asset. Okay, what does revaluation mean? Value meaning like the value of something. Meaning it can move, it can go up, it can go down. So it's assets that have a good, base foundation of safety and security, but they can fluctuate. They could go up and down. So on tier one, the life insurance can't fluctuate. It's guaranteed against loss. That's why we use that. Right. Another example of that might be, a money market where I can't lose my principal, or a bond that I've got the maturity value of it. Right. So those are things that might not fluctuate, but the life insurance is really the best one. The banks are putting their money there primarily. Revaluation means it could go up and down, but it still needs to be what? It still needs to be liquid. Like I need to be able to convert it to cash easily if I need to. I should be able to borrow against it if I need to. And I should also be able to turn it into an income producing asset long term if I'm not going to use it for a while. Right? So this is going to blow your mind, but for most of the largest banks in the world, this is gold. Right? I know the US consumer, we've been told gold is just a rock. It's just a piece of jewelry. Like, why do you need it? It's only for watches and earrings. Okay. Well, did you know that the Federal Reserve Bank of the United States of America, our central bank, like the private entity that the US Treasury borrows money from so that you have dollars to go spend, their number one held asset is gold. 80% of their reserves are in gold. Okay, not 8%, not 10%, 80%. Okay, so think about this. The place, what are they, like whenever I look at an organization, I look at how do they stay in business, I look at what do they exchange out for what do they exchange in? They're exchanging out paper and digits, right? They're giving us currency. So what do they provide? What's their valuable final product outward to humanity? Okay, it's basically valueless paper and empty digits. That's what they're giving to us. What are they taking in? Apparently gold. right? Like more gold than anyone else. That's over $500 billion worth of gold. That's $500 billion, more than $500 billion worth of gold. That's a lot. They're the number one owner of gold in the world, right? And I like to use this example because I like pizza, right? So when I do my cheat meals, I like to do pizza. I like Mellow Mushroom. Shout out to my boys at Mellow Mushroom. You guys know me on a first name basis. But if it's like I like pizza versus I'm the number one consumer of pizza in the world, that's quite the difference, right? So the banks, the central banks, they're the number one owners of gold in the world. So here's why I like gold for my tier 2. Okay. Gold is liquid. I can immediately sell it back to cash if I need to. I can also convert it into other precious metals, right? Over the long haul, it's had about an 8 to 10% annual rate of growth. It can revalue. It can go up and down. It's like a yo-yo. Okay. Don't watch the price every day. You're going to drive yourself crazy. Just know long-term, I'm storing my value. It's over 6,000 years old. It's the only form of money store of value that's still widely accepted and still used. All the other ones have failed and gone away. Gold hasn't, right? So I've got this track record, and then I actually have the ability to use it. I can borrow against gold just like I can do with life insurance. Most people don't know this. When I build up at least $35,000 worth of gold, I can take a loan against it. I can borrow against it and use that to go invest and still have the gold growing. Right? So the growth rate is 8 to 10% on average over the long haul. I wouldn't buy it at all if I don't plan on keeping it for 5 years. Right? So that's my thought there. And then the other thing on this too is, well, it is going to go up and down. So what does that look like? So that's called a standard deviation. Standard deviation. How far does it deviate up away from the average or down below the average? So the average is 8 to 10. It could go 15% above that. So on the high end, it could go up, 25%, and that's a normal range. On the low end, it could drop 15% below that. So I could lose 5%, right? 10 minus 15 is negative 5. I could lose 5%, and that's also completely normal. So it's going to be a yo-yo of like 25 down to negative 5 in that zone, but the average trend over time is that 8 to 10% when we look at the long term. Okay, the max drawdown, the worst year gold has ever had was like 35 or 40% loss. I need to be okay with that, right? Knowing that it did bounce back. Knowing also this, what something is priced in is not its value. Okay, I would never trade gold for dollars, right? If I have gold, I want to keep that. That's worth more than the dollar. The dollar goes down in value, gold goes up in value. Did you know prior to 1971, our dollars were actually backed by gold? Okay, so that means anyone that had a dollar had gold because you had that ability to say, hey, my dollar is actually just a deposit coupon for gold that's stored in the US Treasury with the Federal Reserve. In 1971, they detached it. They said, hey, like here's the track record. People used to carry gold. It was inconvenient. So they deposited it with banks. Banks gave them pieces of paper. It was a deposit receipt, just like when you drop off your dry cleaning. Imagine you drop off your dry cleaning. They give you the receipt and you're like, cool. I go back. I give them this receipt. I can get my shirt back. Then all of a sudden, the owner of the dry cleaning store says, no, you can't get your shirt back anymore. We're keeping all the shirts, but you can go exchange those receipts to other people for other things. And you're like, oh, I can't have my clothes. No. So same thing. We were putting our gold in vaults with banks. We had deposit receipts. We could go turn the receipt in and get our gold back. And in 1971, Nixon, also known as Dixon, he said, hey, you can't do that anymore. We're keeping all the gold. You keep the paper. You keep the digits. We don't want them. We want your gold. We're keeping the gold. It was actually illegal to own gold from 1933 to 1971 because they couldn't just pull the plug on people like that. They had to give them 3 or 4 decades of not being able to own it before an entire generation became desensitized to gold, not thinking they should own it, and they wouldn't care once it got taken away. Hey, what's up? Jerry here. I just wanted to give you another reminder. Grab my book, Blueprint to Financial Freedom. It's going to be one of the best books you have ever read on finance. I can promise you that. You're going to love it. It's also a free offer. So if you go to jerryfetta.com/B2F promo, you can get that now. Okay, so at that point in time, 100% of people owned gold if they owned dollars because the dollar was backed by gold. Now, only 12% of Americans own any gold. Okay, there's only enough gold to go around for a 1-to-1 ratio in the entire world. There's enough ounces to cover every individual. Every individual can have 1 ounce, right? So the fair share would be we have enough for everyone to have 1. Everyone does have 1. Well, guess what? That's not how it works. If you're watching statistically, 1 in 10 people own gold. Like 10 of you are watching, only 1 actually owns gold, and it's probably in jewelry. It's not actually in physical. Right? So you can borrow against the gold. You can build it up as a reserve asset. You can also lease it out for income. You can earn passive income on physical gold. People don't know this because, again, education, they're like, oh, it's just a shiny rock. It's just this, it's just that. Okay, cool. But, this is what banks are doing. This is what the Federal Reserve is doing. right? Now, the third one, tier 3, this is actually real estate. You can own property, you can own real estate and borrow against that as well, okay? And that's another one where you can store value long term. I say that's tier 3 because it is a bigger barrier to entry to own property. You can't buy, 5 grams of land like you could with gold. You can't do $1,000 a month into it like you could do with life insurance. It's like, okay, you got to have big boy money now. I need to have 50K or 100K or 200K to go buy some land or go buy property, right? Now with that, there's also going to be taxes, there's going to be utilities, there's going to be insurances, there's other holding costs that go with it, right? And there's more upkeep. I don't have all these things with gold and life insurance. So when I get into the property, it's a lot less passive. So what I would be doing on tier 3 is I would be using rental properties. I'd be buying single family homes, duplexes, triplexes, fourplexes. I would be using a home equity line of credit. So I'd pay cash, buy the property, put a home equity line of credit on the property after the fact, borrow against the property, have the rental income, have the appreciation, have the tax benefits, then repurpose that money and go invest it. So that's our 3-tier capital system. And if you do this, you're going to have this little trifecta. You're going to have, your life insurance money that's never going to go anywhere. You're completely safe. Okay. You're going to have your gold, which is going to grow long-term, outpace inflation and beat the dollar. And while you have it, you can borrow against it and lease it out. Then on top of that, you're going to own rental properties and real estate, right? And that's going to throw off passive income, and it's going to give you appreciation, and it's going to give you tax benefits. And then you still can borrow against that and then put that into other deals. And it just continues to snowball. If you just did these 3 things, and again, you're copying the largest institutions in the world. When I borrow against the gold and I borrow against the life insurance and I borrow against the rentals to invest, guess what I'm investing in? I'm investing in mortgages. It's called seller finance real estate, right? This is not like if you're watching this and you're like, oh, Jerry Fetta is a genius. No, I'm literally just copying the banks, guys. This is literally what the banks are doing. The banks and the largest investment portfolios in the world, they're doing mortgages. You look at the portfolio of a bank, it's life insurance, precious metals. Sure, they've got some securities and different things. They might do some foreign currency trading, but they do mortgages. They want a single family home paying them for the next 30 years, right? So I'm going to do the same thing. I'm going to borrow against the life insurance. I'm going to buy a property and seller finance that out to a family who's now going to pay me a mortgage payment for the next 20 years where I make 12 to 14% interest. Right? I'm going to do that with my gold as well. I'm going to borrow against it, put that into a seller finance property. I'm going to earn the income on that too. With my rental, I'm going to borrow against my rental. I'm going to put that out there. I'm going to earn the income on that as well. Right? All of these things are now going to go into mortgage payments. Okay, this is how I build passive income that exceeds my savings, expenses, and taxes. So I'm going to wrap it up here. This is the 3-tier capital system. If you're watching this and it interested you, reach out to my team. This is literally stuff we help you with. We can set up each one of these systems and accounts for you. So make sure you reach out, like, share, and subscribe if this was valuable to you. I'll see you next time. Hey, this is Jerry Fetta here. I want to thank you for watching my video, watching my content. I hope you enjoyed it. If you would like to learn more about the blueprint to financial freedom and how you can achieve passive income that exceeds your savings, your expenses, your taxes, your generosity, and build wealth like the top 1%, I want to encourage you, grab a copy of my book, The Blueprint to Financial Freedom. You can go to jerryfetta.com/B2F promo, or you can click the link in the description of the video here. The copy is free. You cover your shipping. We'll send the book out to you, and we'll send you an email with a bunch of great bonus material also for free. Get the book, subscribe to the channel. I'll see you on my next content.